Further developments now. Analysts have expressed mixed opinions over a proposal by the South African Reserve Bank to replace the lending rate with the repo rate. This would mean a unified metric for lending and could lead to lower rates in some cases. While a risk profile will still be at play, the proposed change will require banks to disclose and spread their charge above the repo. We now speak to KPMG lead economist Frank Blackmore about these developments. Thank you so much for your time, Frank. Let's first talk about the reasoning behind the central bank's proposal.
Well, the main reason given by the bank is that the prime lending rate has evolved into something that is sort of far from what it should have been. So, in other words, in the original days, the prime lending rate was that rate or base rate given to the prime clients of a bank. Now it's basically a reference rate, so it's largely administrative. And it's detached from that original purpose of being a base rate. It's also what we currently understand as 350 basis points above the repo rate, or that policy rate is how most people would understand that rate now. But it's moved away from being a base rate.
Having explained that, maybe just go into how much of a material difference this makes for you and I and the rest of South Africa.
So it shouldn't make a lot of difference to most of us, because currently banks are pricing not on the prime lending rate, but they price on a number of factors, including the cost of their funding, their risk profile, as well as the risk profile of, the risk appetite, their risk appetite, and the risk profile of their client or client business. And that price is then built up. And when they give it to you, it's referred to with reference to that prime lending rate. So all that's going to happen now is it's going to refer instead towards the South African Reserve Bank's policy rate, or repo rate as we know it. So instead of having an interest rate of something like prime plus or minus 1%, we'll have something that says repo or policy rate plus or minus 3 or so percent.
Lastly, what does it mean for individual banks in how they conduct their day-to-day around this particular matter, especially as much more transparency is going to be required?
Yes, exactly. I think mostly for banks, because the fact that they're determining the interest rate that you and I borrow money at, according to that formula, which doesn't use the lending rate, the only real difference will be the reporting of that rate to you and I. So there are going to be obviously some changes with respect to the IT systems and operations within banks, but this is going to be phased in over time. There are obviously clients as well out there that have current loans that are referred to with respect to that prime lending rate, and they will have to be notified what those new rates will be. Not that the rate itself will change, but the rate with respect to the policy rate will now have to be quoted instead. There should be no change for those type of loans based on their risk-based pricing that they're currently doing.
Thank you for your input. KPMG lead economist Frank Blackmore speaking to us about the reasoning behind the central bank's proposal to change the lending rate to simply being a repo rate.